Today is the 13th of March 2021. My name is David Hickson, and in today's market update we're going to be taking a look at what we are expecting to happen next. Before we do that, I must ask you to please make sure that you have read and understood these disclaimers. A comment was posted on last week's market update video suggesting that I start with the bigger picture, explaining where we are at the moment. I think that's a great idea, so let's quickly do that. Here is the analysis that we have been tracking over many weeks now, or months in fact, and you can see I have data displayed from about the middle of 2008 up until yesterday, Friday the 12th of March, and the analysis is plotted at the foot of the chart. Of course, we mark the position of the troughs of the cycles with these diamonds. It is what I call Hurst notation, because Hurst came up with the idea of marking the troughs of the cycles in this manner. And the reason that we mark the position of the troughs and not the position of the peaks is because of the principle of synchronicity, one of the 8 principles that Hurst defined, which tells us that the cycles which influence the price movements of stock markets are synchronized at their troughs. And because they are synchronized at their troughs, they are not necessarily synchronized at their peaks. And so we have marked the position of the troughs with these diamonds. I am also displaying these semicircles at the foot of the chart because I find the semicircles make it a little easier to visualize the analysis. So what is this analysis telling us? Well, you can see that we have a long-term cycle, in this case a 9-year cycle, which formed a trough in 2009. The next 9-year cycle formed a trough here in 2016. And the next 9-year cycle that we're looking at is, of course, not formed yet, because it is only expected over here, where we have this triangle standing on its head. This is what is called a nest of lows, where we get a cluster of expected cycle troughs. And they form this sort of triangle standing on one of its points, and that is in about 2024 or perhaps late 2023. So that is the 9-year cycle, and we can see the progression of the 9-year cycle, if you like, by looking at this semicircle, with it rising over this period of time and falling over this period of time, and again rising and falling. The next shorter cycle is the 54-month cycle, which you can see, according to this analysis, formed a trough over here in 2012. Of course, it formed synchronous troughs with the 9-year cycle at these positions, and the most recent position of the 54-month cycle was, according to this analysis, in March of 2020. Now, you will know that in previous market update videos I've discussed the possibility that in fact this 9-year cycle trough might have occurred here in March in 2020. I'm not going to repeat all of that information because I would take the whole video probably to explain the ideas behind that. So let's just go with what we have on this particular analysis at the moment and discuss then where we are at the moment. So if the market started bouncing out of a 54-month cycle trough in early 2020, that would explain the recent bullishness. What is expected to happen next? Well, what we do is we look at all of the cycles that we have information for on this chart, which is all the cycles up to the 9-year cycle. And if we performed an analysis over more data, we could start considering the 18-year cycle and perhaps even longer cycles. But in terms of the really long-term picture, we are expecting the 54-month cycle to elapse something like this, go up and then come down into when the next 54-month cycle trough is expected. So that's the sort of really big picture in terms of what we're expecting. As you can see, because there are 3 18-month cycles within each 54-month cycle, we are expecting those 3 cycles, and so we can add those cycles in there. 1, 2, 3. Okay, and as we work shorter and shorter, we would of course add in the shorter cycles. But in terms of the really big picture, what is happening at the moment is that we are expecting the market soon to turn down into this first 18-month cycle trough, and then we will get another 18-month cycle, and then a third 18-month cycle before we hit the big trough here in late 2023 or early 2024. Let's zoom in and take a look at a bit more detail. As we zoom in, I find the semicircles less useful. They become a little bit confusing, so let me get rid of the semicircles and let's just focus on these nests of lows. You can see them over here. So that's the next 18-month cycle. And then over here is a very staggered nest of lows for the following 18-month cycle. And then here is our nest of lows for the next 54-month or 9-year cycle trough. So a few things to say here. First of all, of course, we are expecting 1, 2, 3 18-month cycles to elapse before the big trough over here at the end of 2023 or early 2024. The next interesting thing to comment on is why this nest of lows over here is so broken up and so staggered. That's because the further we look into the future, the more the cycles tend to drift apart. And that is because of another one of Hurst's principles, the principle of variation, which tells us that the cycle wavelengths and their amplitudes are constantly varying. So we speak about an 18-month cycle, and in fact over time that cycle, when you average all the different lengths of that cycle, does average a length of about 18 months. But each iteration or each wave of that cycle will vary from that 18-month length. And in fact, if you look at the bottom right-hand side of the chart, you can see that recently that cycle has been averaging 16.3 months, which is a good deal shorter than 18 months. And so the reason that we get this staggered nest of lows, and let me just erase that over there so that we can focus on it. The reason we get that staggered nest of lows is because this 18-month circle is being projected on the basis of about the past 4.5 or 5 years worth of that particular cycle, whereas the 40-week cycle is being projected on the basis of only about half that amount of time. And so as these cycles breathe, as their wavelengths compress and expand, you will find that these nests of lows in the future start breaking up and becoming more staggered. But that is our bigger picture in terms of what we are expecting now. So we are expecting price to come down into an 18-month cycle trough. Then we'll have another 18-month cycle and a third, and price will come down into this trough over here. I'm going to zoom out one more time because I think there's a very important point to be made. When I speak about price turning down into an 18-month cycle, sometimes that sounds like a really big dramatic event. And I'd like to point out what happened when price turned down into this first 18-month cycle trough over here. That was in about the middle of 2017, following this big trough in early 2016. If you look at price, can you see the 18-month cycle trough over there? It's not very clear, is it? The reason for that is because the longer cycles, in this case probably the 54-month and maybe the 9-year cycle, were having such a strong influence on price that were pushing up that the 18-month cycle was obscured. Another reason why a cycle trough will be obscured is simply because of fundamental events. Perhaps there is, I hesitate to call it manipulation, but perhaps quantitative easing is happening, or the banks are feeding extra money into the system, they're supporting the stock market. There are many reasons why prices can become a little distorted, and of course there are other influences on price. Cycles are not the only things that influence price movements. If we go back and look at a previous time that an 18-month cycle trough formed after a 9-year cycle trough, you can see this trough over here was more evident in the price movement, and so we did get a good strong rise and then a drop down. The other thing that you will notice is that whenever we have a trough forming after the trough of a much bigger cycle, the peak tends to occur late, and then there is a much shorter period of time in which price drops down to form that cycle trough. That is what tends to happen when we have a bullish underlying trend or the bullish contribution of longer cycles. And so exactly the same is expected at the moment in terms of price turning down and forming the first 18-month cycle trough. We would expect this peak to occur late because of the magnitude of the trough in March 2020. And so that is the bigger picture. We are looking for price to turn down at some point and form an 18-month cycle trough, probably in about the middle of this year or a little after the middle of this year. So let's take a look at what is happening now, and I'm going to zoom in like that so that we can still keep in view the expected 18-month cycle trough that is lying ahead of us. In my previous market update video, I was speaking about the formation of a 20-week cycle trough, and indeed it would seem that that 20-week cycle trough has now formed. And it did so at the level of the 20-week cycle FLD, which, if you take a look at last week's video, was one of the possibilities that I suggested. And so we are expecting price to, of course, bounce out of this 20-week cycle trough. I mentioned in last week's video that we might not see very much of a higher peak, but it looks as if the price is going to break above the previous peak over here, and at some point it needs to turn down and come down into this 18-month cycle trough, which we are expecting there. Another way of visualizing the analysis that we have on our charts is by taking a look at the composite model line. The composite model line is a line that is composed out of the cycle analysis that is on the chart. So it takes the information about each cycle's wavelength and amplitude. As that cycle has been identified in the analysis, it combines that information and it produces this dashed orange line. It then extends that orange line into the future, assuming that the wavelengths will remain constant and the amplitudes will remain constant, which is of course a flawed assumption because of the principle of variation. But it does give us a very useful way of visualizing the implications of an analysis. And you can see that the implications of this particular analysis are that price is now bouncing out of this 20-week cycle trough. It is going to come up to form another peak at some point, perhaps over here, at which time it is going to turn down and move downwards into this 18-month cycle trough over here. Now, the composite model line gives us a very good idea of the structure of the move and the timing of various elements in the move. It is not very good at projecting price. The reason for that is because the amplitude of each cycle, in my experience, is the most variable part of that cycle. And we also don't know what other influences there are going to be on price that might cause the amplitude of various cycles to increase and the price movements to be greater or lesser than expected. Nevertheless, this dashed orange line, the composite model line, gives us a very good idea of what to expect in terms of the structure of the move. In other words, price is moving up now. We are going to see another peak and then price is going to move down. So how far is price going to move up now? Well, we can generate a target on the basis of price having crossed the 20-day FLD. We can generate targets on the basis of price crossing any FLD. So let's quickly do that. I mentioned in last week's video that one of the ways that we could know that price had formed the 20-week cycle trough in the markets was when it crossed up above the 20-day FLD. And you can see that it succeeded in doing that this week. In fact, it did rather an interesting thing. As you can see, price came up to the 20-day FLD and spent 3 days straddling that FLD before it clearly broke up above it. So where do we actually measure the crossing point? That's quite an interesting question, and one way in which we can measure the crossing point is to work out the point at which the median price, the mid price between the high and the low price of each bar, crossed that FLD. The FLD is of course based upon the median price. So let's take a look at that median price. And there is the median price, that orange line. You can see, very interestingly, the median price actually literally tracked on top of that FLD for a couple of bars there, and it only finally broke up above the FLD over here. But as a result of price crossing up above the FLD, we can of course generate a target. And because the cross was a little bit of a messy affair, in this case we get a little bit of a range, and the target that I calculate is at a level of about 40.20 up to about 40.35. And so we have a little bit further to go on the upside. I would not be surprised to see price rising up to those levels, after which price is expected to come back and find support at the level of about the 20-day FLD. So in terms of the near future, the next few weeks perhaps, things are still looking fairly bullish because of the fact that a 20-week cycle trough has formed. But we need to start being aware of signs that the market is beginning to turn down because of the fact that we are expecting it to come down into the 18-month cycle trough later this year. Is it possible that the drop into the 18-month cycle trough will not be a big one? Yes, of course it is. As I demonstrated earlier, it is possible. So what we need to do is keep watching the market carefully, looking for signs that the market is turning bearish. Until it actually gives us those signs, however, things are still bullish. It is worth pointing out that price could certainly exceed those targets. The targets that are calculated as a result of price crossing the FLD would represent the point at which this A category interaction, which is the first interaction with the 20-day cycle FLD that follows a trough of at least 80-day magnitude, which of course a 20-week cycle trough is, that target represents the point at which the A category interaction is fulfilled, but often an A category interaction results in the target being exceeded. And so it wouldn't be a very big surprise if price reaches beyond those targets before it turns down and finds support at the level of the 20-day FLD. I do hope that you found this market update interesting. If you have any questions, ask them in the comments below the video or send us an email. I look forward to hearing from you.